Hello, and welcome to this manufacturing management webinar in association with Inenco. My name is Paul Fanning, and I'm editor of Manufacturing Management. Today's webinar is entitled "Managing the Impact of the Energy Market: What Happens Next?" and will be presented by Alex Wilson, Associate Consultant at Inenco, and Stuart Lee, Inenco's Associate Director of Procurement and Trading. Before I hand over to them, however, I'd just like to take a moment to say that if you have any questions during the presentation, please type them into the box on the right-hand side of your screen, and we'll attempt to answer them at the end. If by any chance we don't have time to answer your question, please rest assured that we'll hand it over to Inenco and they'll answer it for you offline. And with that, it just remains for me to hand over to Alex. Alex.
Thanks, Paul. So Paul's just touched on it then, but in terms of what we're going to cover today, we're going to take a look back at the past 24 months of the energy markets and what's gone on. We're going to take a look at some future current liquid prices, what might happen next, and more importantly, how you can best mitigate cost impacts through the correct procurement strategy. I'm then going to hand over to Stuart, who's going to cover off timing, contract length, and market cycles. If you didn't know who we are, this is myself and Stuart. So two handsome chaps. Now, this slide has probably been seen by quite a few of you before. Everyone that's come onto the previous webinars will have seen this. But for those who don't know who we are, we're Inenco. We were established in 1968. And what that means now more than ever from a volatility perspective is there isn't really anything in the energy markets that we haven't seen before. So we're active during the Middle Eastern wars of the 70s, the miners' strikes of the 80s, the market deregulation in the 90s, the 2008 financial collapse, the old market high, which was the beast from the east in 2018, and the current energy crisis. Now, back in 1968, when we were first founded, the energy market was a completely different place. It was regulated. And back then, Inenco essentially got a trade at doing invoice validation. Essentially, it's where we process large users' bills, look for errors, and then provide refunds to our clients. Still a large part of what we do today. We process, this year, we're looking to process about 1.6 million invoices. And last year alone, we got about £11 million in refunds for our clients. Fast forward to 1998 and the energy market, 1994, and the energy market deregulated. Inenco pioneered wholesale procurement. And where we sit today is we procure annually around £5.4 billion of energy, or around 27 terawatts. Now, a point I always like to touch on this slide is that, Inenco is a company of around 300 people, and I sit on an outbound consultancy team of around 6 people. So we're very focused on service delivery. Now we're going to go straight into the market update. Normally this slide builds throughout, but because of the presentation format on Big Marker, it's already loaded. But it's really important to know how we got to where we are at the moment. So we're going to take a look at the snapshot from the past 24 months. A lot of people don't realize that the energy crisis really originated from lockdown. And essentially during lockdown, energy prices fell off the cliff. Manufacturers locked down, people weren't using as much energy, people were working from home. Prices fell to about 3.5 pence a kilowatt at one point. Now, after lockdown, the UK stayed in lockdown for quite a while, a few intermittent spells, but in around March time, Southern Hemisphere manufacturing companies came out of lockdown and ramped up manufacturing. Now, they did this through a product called liquefied natural gas, and essentially they took out 1, 2, 3, 4, 5-year contracts as long as the market was liquid to purchase liquefied natural gas. And essentially what this did was it caused a spike in the market, and realistically when the market reacted was during a process called gas injection season. Essentially it's where large European gas storage facilities look to take availability of gas to store over the summer and then eject into the gas networks in the winter when the market is most volatile. So when the gas injectors looked to take availability of gas, they found that there was very little, or that there was none in some circumstances. which essentially caused a spike in the market. And at that point there on the screen, where the arrow from gas injector season, that was the market high. Now, Europe wasn't worried. The UK wasn't worried. There was going to be a saving grace called Nord Stream 2, which was a physical pipeline that was going to connect Russia to Germany. Now, this was going to solve all our gas problems at the time, fill up storage facilities. But if you are a follower of the news or keep up to date with these activities, then you'll know that Nord Stream 2 was delayed, and then eventually it was cancelled. This caused the market to go on this bullish run, which was the first step of a completely unsustainable market. What happened next was on the 2nd of Feb, Russia declared war with Ukraine. And again, this caused another huge spike. Now, the reason for that was at the time, Europe got 47% of its gas from Russia, which is quite a lot. The UK, we're quite fortunate. We only got around 7% of our gas from Russia at the time. But the problem with gas is there's not really many places to get it from. So it was a panic of where else are Europe and the UK going to source this gas from. Now, the market carried on running, and a number of events caused it to reach its peak in August. So we had a number of LNG facility fires across America. There was issues with Nord Stream 1, political power moves, wind turbines being repaired in Canada. There was gas being burned on the Finnish border. I think the most latest of those was the sabotage of a pipeline. Pulitzer Prize journalists reported that it was America, but who knows? Now, like I said, the market peaked about £776 a megawatt, and a very unsustainable level. It's not listed there, but what hit the final nail in the coffin was essentially that Europe mandated that gas storage facilities had to be 90% full. But what they didn't mandate was a price. Now, since then, it's been some very good news. The market has dropped off massively. And in terms of where we are now and how we've got there, we've had some really good renewable generation. So from around September, October, November, December, and half of January, I think about 50% of our electricity generation came from renewable sources. We've managed to win some LNG contracts, which is probably primarily due to China going into lockdown, which has meant that competition for these contracts hasn't been as competitive. Low demand for gas. So this is unfortunately related to the cost of living crisis. So companies and domestic users of gas are choosing to reduce their consumption. In most cases, families are choosing to eat rather than heat. And the weather's played a huge part. So I think, if I'm not correct, we've had the mildest winter for 30 years. And that has been a continuing theme for the past couple of years. We've had very mild winters, which has meant we've not had to export as much gas. So where are we at the moment? So before I get into prices at the moment and what the market's looking like, this might be a little bit alien to some people. So along the side, we've got winter 23, winter 24, winter 25, summer 24, summer 25, and summer 26. Now, energy is traded in seasons. So the season of winter runs from the 1st of October to the 31st of March. And the summer season runs from the 1st of April to the 31st of September. So if you were to buy a full year's of energy, you would need one winter season and one summer season. So a blended rate of the two would provide you with a representative commodity rate for 1 year's worth of energy. Now, if we take the 14th of April, for example, a winter contract was trading at £157 a megawatt, or 15.7 pence a kilowatt. Now, early on, Inenco's traders noticed that the market was in a state of backwardation. Backwardation is just a fancy trading term for the further out you look, the cheaper the prices get. Now, these are real prices. from the 14th of April. This is just a snapshot, but if you were to buy energy on those days, that would be the price that you would pay. Now, what does this mean? Now, it's all, well and good me showing you previous prices and how much things cost, but I want to put it in the frame of mind for yourselves. So currently, for electricity, on a snapshot of today's price, the market is trading at £157 a megawatt, or 15.7 pence per kilowatt. Now, whilst I've talked about the good news of the market dropping and coming down a long way due to the events that I mentioned, over the past couple of weeks, we have noticed a turn, and we have noticed the market rising. Now, if you look at the prices right now, they have risen on the past 6 weeks around 19%. And in terms of a 1 gigawatt hour user, so someone that is using 1 million kilowatts, the price increase from the 22nd of March to now is around £12,000, £12,570. Now, if you're a 5 gigawatt user, you can do the multiplication there, but it's quite a large cost increase. So what are the answers to this? Well, historically, this is a big increase on price. So, a lot of you might be coming out of a 2019, a 2020 contract. Some of you might be coming out of a contract that was very short term, which you were paying a high price for. But before we move on to the solutions, looking at the historic situation paints a picture of how expensive prices are at the moment. So historically, you'd be paying around 4 to 5 pence per kilowatt of your commodity. And just to put it in perspective, the commodity rate at the moment is 15.7 pence a kilowatt. That's almost 3 times as much. Now, non-commodities, you'd be paying around 6-7 pence a unit, and a fully delivered rate at around 10-12 pence per unit. Now, if we were talking historically, non-commodities do rise at a relatively steady rate, but unfortunately, it's a bit of double bad news. We have seen quite a large rise in non-commodity costs at the moment. And that is due to the fact that some lines of non-commodity are directly linked to the commodity price. So as the commodity goes up, so does the non-commodities. So this paints a picture of what people have been previously used to. And if you're coming out of a contract, looking at a new one is going to be quite alarming. Now, how do things look in the future? So if you don't know this, the energy market is liquid for 5 years, and I've touched on it with the seasons. But what that means is essentially you can forward purchase for your electricity and gas to be used in a later year. So right now we're coming up to the season of winter 23, which is the next available season to buy, which starts from the 1st of October. And the last season you can currently purchase at the moment is winter 28. Now, what's interesting to note is that currently prices are high, but as we look further out, that term backwardation that are used, you can purchase right now a season of summer 28 at £72 a megawatt, or 7.2 pence per kilowatt, which is almost, it's more than half of the current commodity price. So what we're saying at the moment, and Stuart's going to touch on this later on, but contract length is really important. There's a lot of value to be found in those later years, and that's something that we're going to cover later on. So how do we access the market? How do we provide value and benefit from current prices? Well, before I get into that, there's 2 types of market, and some of you might sit in different markets, but I'm going to cover both of them today. So there's a retail market and there's the wholesale market. Now, the retail market is normally when a customer, let's say a manufacturer, rings up a broker or rings up a supplier and says, we've got a contract for renewal in a month's time and I'd like some prices. What will happen is on that day, supplier or broker will say, yep, sure, I'll get you some prices. 5 minutes later, they come back with a spreadsheet and it'll say a number of suppliers and a number of prices. This is the retail market. Retail markets essentially fix you into a contract on the day that you essentially go to market. Now, with the retail market, that when you go to market that day, you are locking in the commodity price. There's nothing you can do about your taxes and levies. There's nothing you can do about transport and distribution. The only thing that you can negotiate on that day when you speak to your broker or your supplier is the supplier margin. Now, this shocks most people because supplier margin is only about 5%. And of that 5%, 1% is profit. So you could be the best negotiator in the world, but if you think that you're going to negotiate away a 1% profit margin, then you might be thinking incorrectly. Now, what I'm going to talk to you today is the wholesale market. Now, in a nutshell, wholesale procurement essentially monitors the market and looks for the best time to enter the market to buy your energy. And Stuart's going to come onto this later in terms of contracting. But what we like to do is work with an organization 6 to 24 months in advance of contract start date. And the reason for that is so that we can monitor the market, look for drops in the market, and look for the best possible time to enter the market and purchase your energy. Now, there's still nothing we can do about taxes and levies or transport or distribution. Now, one thing we can work on is supplier margin as well. Inenco has a number of portfolios, which I'm going to talk to you about in a minute, with some of the largest suppliers in the UK. And we have these baskets that have quite a large amount of energy spending, which means we can negotiate hard on supplier margin. So how do we enter the market? Well, there's a couple of options. There's portfolio, and then there's also standalone bespoke flags. And what I'm going to talk to you about today is portfolio, but essentially it's a basket product that aggregates users' energy spend. Typically, we work with anyone that spends around £100,000 on energy. That's the entry point. The portfolio is for sort of small to mid-size energy users. And like I touched on before, some of our baskets have about £300 to £400 million worth of spending, which allows us to negotiate very hard on supplier margins. Now, within the portfolio, you will have access to your own supply agreement, and you will have access to your own strategy. Inenco has 4 strategies. You can actually mix strategies, but we're going to keep it very simple for today. So fixed strategy is what it says on the tin. It would be a fix within the portfolio. You can benefit from the added benefits of the portfolio rather than just doing fixed retail. There's also the prompt strategy. I know I'm missing some here, but I'm going to come back to capped, which is essentially day ahead trading. And then there's trend strategy, which essentially splits up your energy buying into a number of trenches. The cap strategy is what I'm going to talk to you about today. Now, the capped essentially is an automatic buying mechanism. On day one of trading, what we will do is take a look at the energy seasons. So, for instance, if we're going to go purchase for 3 years worth of energy, we'll look at winter 23, we'll look at winter 24, winter 25, summer 24, summer 25, and summer 26. Now, what we'll do on day one of trading is we'll put a cap in place on each one of those seasons of energy. Now, the cap will be put in at a couple of percentage points above the market price. Now, what this does is for finance teams is we can essentially say, here's your worst case scenario. This is a budget. This is a number that you can put in your budget. And what the cap does is the cap essentially tracks the market down, but doesn't track the market back up. It provides very high protection, and it can also provide an optimized price. So what do I mean by that? So this is a sales slide. I will tell you that, the market isn't currently looking like this. And normally this does build out, but due to today, I'm just going to talk you through it with my mouse. So for instance, let's say the market is currently trading at £200 a megawatt. It's not, but I just want to keep my maths simple. So what we'll do is we'll set a cap, a couple of percentage points above that. So let's say at 210. And the market is currently dropping in this instance. And when the market starts to rise, the cap stays in place. It won't rise with it. The market then drops, and so does the cap. Now, if the market rise, again, the cap will stay in place. Essentially what happens is the percentage points between the cap and the market get shorter. Now, at some point, the market will intercept the cap. It's at that point that will lock out your energy. Now, within the cap strategy, there is the potential to unlock a proportion of your energy. Within the cap strategy, it is a small percentage. If you're looking to do more, then the cap strategy isn't for you. So in this instance, what we do to essentially unlock a proportion of your energy is we'd look for a downward trend in the market. Now, the reason we look for a downward trend is because we do have to buy that energy back. So at point 3, we've unlocked a proportion of our energy, and at point 4, we've bought back. Now, the difference between the two, the reason for unlocking and locking a proportion of energy is to essentially create trading benefit, otherwise known as profit. And what the cap strategy does is, in those instances, when we create trading benefit, that benefit will go directly to you, the customer, and come off your final energy bill. Now, I've touched on it there, but I don't think it's one size fits all for energy. Depending on your appetite for risk, depending on what kind of supplier you're looking for, one size fits energy. It doesn't really work. So when you come on board with Inenco, for instance, what we do is a risk management scoping session. We'll also have a sustainability kickoff meeting as well. Now, within the risk management scoping session, we'll factor in what type of supplier you're looking to work with. Are you looking for green electricity? Are you looking for green gas? Is there a premium to pay for those? We'll factor in your consumption. So a number of clients I speak to are currently going to be looking at a large scale renewable projects over the next couple of years, and their consumption might reduce massively. Now, this is important because a number of suppliers will have volume tolerances in place. So they'll normally have an 80-120 rule, where if you use less than 80%, then you could be in place with a fine. And again, if you use more than 120% of your energy, then again, you could be fined. So understanding clients and factoring in the consumption is extremely important when picking a supplier and when choosing an energy management strategy. Stuart, I'm going to hand over to yourself.
Good afternoon, all. So Alex has taken us through what's happened in the market, where we are at the moment. But I think it's really important that we start to consider, given what's happening, given where it's been, what should we do and how we should do it. When I speak with clients, I talk about a few simple things: timing, when to do something. I talk about how long to contract for as well, and I talk about the way in which people should buy. I think the key for me in terms of timing is that the energy markets are hugely volatile, and over the last couple of years, we've never seen it as more volatile. So we used to say it was volatile in normal times, and you could see a swing in price over the year of up to 100%. If you think about the volatility that we're seeing at the moment, if the previous base price was, say, £50 per megawatt hour, it peaked at nearly £800 per megawatt hour last year, then the level of volatility we're seeing in the market is tremendous. Therefore, the cost of getting the timing wrong is horrendous, but the benefit of getting the timing right is really important. So when people say to me, kind of, when should we buy our energy? The key point for me is that it's not about a one-off decision that you make just before the contract renewal point. It's about making that timing decision at a time in the market when it's best to do so. If we look at the next slide, Alex will just move us on. Linked to that, it's contract length as well. So again, timing. Quite often I see that a lot of energy buyers will buy a 1 year deal just before their renewal date, and then they'll diarise it to kind of relook at it next year at the same time. Actually, if the prices are really low, then a 1 year deal isn't the right thing to do. A longer term contract is the right thing to do. In terms of how far you can buy out, then it's a max of 5 years. It's credit dependent, it's market liquidity dependent, but you can buy out for up to 5 years. If the prices are really high, then kind of fixing at the market high for a long period of time is clearly the wrong thing to do. So what's really important is to understand where we are in the market cycle, and also once we've understood where we are in the market cycle, then we can start to determine how long we should buy for and how we should buy the energy as well. So if we move on to the next slide, Alex, this is the market cycle. We've actually used the previous 2 years, 2 cycles, sorry. You can see that the average cycle duration is 5 years, which coincides with the maximum amount of time you can buy energy in the market. There's a fairly clear pattern here in that the low of the price for electricity and gas was around 40. And the high of the price went up to kind of 70, 80. So in 2016, it was really clear that the market had hit its bottom because we were at that low price. And again, in 2020, it was really clear we'd hit the bottom of the market. We're in COVID times, and the energy prices, Alex had described before, they're on its knees. So if we were to buy at those times, it's really simple. It's we'd say to our clients, listen, the prices are really low. You should buy now for 5 years if possible, because regardless of what happens now over the next few years, you will pay more if you continue to buy in those 1 year tranches. And actually, that really simple advice was really effective in helping our clients buy at the right time. And given that a lot of them, we were able to buy 4 or 5 years in 2020 for them, they've been protected about what's happened in 21 and 22. It's more challenging now because the old world view of the market, where 50 was a good price, 40 was a really low price, 60, 70 is bad. Those prices are no longer relevant. We're in a new world. So for all the reasons Alex has described, the price of gas and electricity in the UK and Europe isn't going to go back down to the levels that we previously experienced for many years to come. If we try to identify where we are in the market cycle, then I think most people would agree that 2022 was the peak of that market. So, in August 22, we saw the ultimate peak of up to 800. Prices have dropped down significantly since then for 2 reasons. The first reason being that Putin thought he was weaponizing gas by threatening to turn off the gas supplies. Markets hate risk and uncertainty. Actually, by turning off the gas supplies as he did, it took away the risk and uncertainty, and therefore we saw a big dip in the market. Second, we saw over the winter, we were expecting a very troublesome winter on the markets, but because of the mildness of temperature that brought demand down, and also because of COVID lockdown in China, that meant their demand was down, but there was an increase of LNG supply into UK and Europe. Prices are kind of artificially low at the moment. So as we kind of move into this year, then the industry forecasts for prices were probably around 200 to 250, depending on which forecast you use. The average for the year so far has been somewhere below 150. So it just shows how much lower we are in terms of a market price than anybody had expected. Actually, if you look at those long-term forecasts and you look at where the current prices are, so for future years, so as Alex has said, that the future years are backwardated, they're cheaper than the current year. When we get to those years, the prices that industry forecasts are expecting us to be at, we're currently at much lower levels at the moment, and that's driven by what's happened in the winter. So it's the temperature, and it's also LNG flows because of Chinese COVID lockdown. If we just kind of look forward a little bit more, then the issue we've got is we're unlikely to see another winter as mild as we have done this winter for a second year on the bounce. Also, it's very unlikely China will be in lockdown again, and therefore there will be much stronger LNG demand from China. And therefore, we're expecting a much more troublesome winter this year. We're expecting storage gas to be used in a large way in Europe and UK over the winter. And unlike this summer where our storage gas will be really full because we've not needed it, we'll have to compete for gas really heavily next summer because the storage levels are likely to be very much lower than they are now. So what does that mean? It means that the buying opportunity now is actually very good. If you leave it until closer to this winter, next summer, then there's a big risk that actually prices will be higher in those periods, and that will not just affect the near year, but it will affect kind of future years as well. So for us, what we're saying to people is we don't like the current market prices. If it's 150 or 100, depending upon what year we're looking at, we don't like them because what we liked was the 50 that we were used to. However, we've got to accept that we're in the new world. And if the new world is saying, we could be seeing prices as high as 200 and 250 over this market cycle, then if we're able to buy now when the price is 100 to 150, so significantly lower than future year predictions, plus heavily discounted versus 2022, then it does make a good kind of buying window for us. The buying window is restricted because we do fear that we can start to see price spikes as early as September this year. So that window of opportunity it is there, but it will erode as we get closer to the winter. It will take a period of time to get contracts in place with suppliers. Credit is a big issue at the moment, so it can be 3 to 4 weeks in order to get through a credit check and contracts out from suppliers. So given that kind of window of opportunity, then we are saying that there's an urgency to act at the moment because it would be best to be in the market ahead of the summer and to be able to start to make decisions. Having given quite a strong guide as to what we'd recommend you do there, I think it's also prudent that we acknowledge that the markets are very volatile and the unknown can happen. And therefore, we've got to be able to react to changes in the market. So if it's a bad change in the market and prices go up, then if we've adopted the cap strategy that Alex spoke about, then that cap gives you kind of ultimate protection. So therefore, it prevents the prices from getting higher for you. However, whilst it's unlikely, it's possible that prices fall, then again, in the trend strategy, there's the ability to sell back to the market after we've bought it as well. So if prices do start to fall, then it allows us to try and kind of reposition the price against that falling market. So in terms of the balance of strategy, it's given current prices, given price forecasts, it's right to heavily on the side of caution and therefore protection capped. But unlike a fixed price deal, it's very important that you've got the ability to readjust to a price as well. And therefore, if prices do the unexpected, we can take advantage and we can see if we can lower the price if those market prices fall. So in summary from me, pricing at the moment is good. It's not good compared to what we've known in the past. It is the time to take action. That window to take action is limited. If it was me buying, I would not want to be buying as late as September this year. Do bear in mind it will take you some time to get a supply contract in place. So again, that window of opportunity is further limited. And in terms of how to buy, I'm a strong advocate that it's bought in a flexible way. And the last couple of years where the market's moved all over the place kind of really kind of back that up. If you take a fixed price, it could be it could be a bad decision. If it's a bad decision, there's nothing you can do about it. On a flexible bought contract, you're more likely to buy at a better place anyway. But if the market does change, you can do something about it.
Well, cheers, Stuart. I think we're going to go to Paul now for some questions.
Yes, indeed. Thank you very much, both Alex and Stuart. I have a question here. We touched on it briefly, I think, Stuart, there, but would you be able to get credit card booking 4 years in advance?
Yes, theoretically it's possible. And quite a lot of times, one of the biggest challenges we're facing for our clients at the moment is about credit decisions from suppliers. And it's worth maybe spending a couple of minutes on that. The risk to suppliers is massively increased in the last year because the price of the underlying cost of the commodities increased significantly. So if, for example, they were seeking a credit risk on an organisation of £500,000 previously, they could be seeking a credit risk coverage of 1.5 million at the moment. So that's why a lot of suppliers are seeming to be harder on credit than they have done in the past. It's not they're wanting to. It's just it's forced on them. The max credit coverage you'll ever get in the market is 5 years. The reason for that is it's how the market operates in terms of its pricing. So you can only understand your risk if you understand the prices for the period you're covering. The manufacturing industry, in terms of the credit agencies, so Artradius, your Hermes, we're finding that some of the biggest struggles are in the manufacturing area. What we have found, though, is the right suppliers aren't a supplier that kind of have the computer says no response. The right way is to work with the supplier and, in our case, our clients, to help both understand the the risk of a client, instead of just a simple credit check, let's kind of get under the bonnet a bit. And what we found in those cases is that where we've had suppliers giving a credit no, we've been able to, in some cases, turn that to a credit yes. And we've also been able to increase the length of credit coverage in terms of years as well. So it's more involved. And for us, I think where we can get suppliers and organizations talking, that's when we find we can start to get a resolution to it. What kind of advantage do we give there? It's our contacts and our kind of sway with the suppliers. It's about getting the right people talking. And once we get the right people talking, we tend to find we get more helpful decisions.
Okay. And another question here. Our contract is up for renewal in October. Our FD wants us to wait until nearer the date to contract. But from what you say, that might not be the right approach. Is that right?
Yes. So, more and more we're finding that the contracting decisions are FD or CFO kind of decided. Understandable, because they've got to manage the impact on their business of those costs. My big worry this year is that people will have looked at the prices back in 2022. They might have had a really bad shock. They've seen prices fall at the start of this year. The mindset may be, well, let's hang on. Let's see if we can see prices fall any further, and therefore they'll gamble. It's a massive gamble. If you look at where prices are moving currently, they're moving up. So they're already moving up. It looks like we may have seen the low for the year already. The fear is that you leave it late, and given the constraints in terms of how long it takes to get a contract in place, if you leave it late, you could be leaving it to the spike. If you leave it to the spike, as most people have suffered in 22, there's no recovery. So I would strongly urge people not to take a leave it to the last minute approach. I think it's the most risky thing you could do in this market this year.
And how big does an organization need to be to benefit from the sort of trading approach you've described?
So in terms of the benefit is it relates to the amount of consumption. So as a kind of a percentage benefit, then whether you're one of our smaller users or one of our larger users, then as a percentage, the benefit is the same. Obviously, if the larger user gets a bigger pound note benefit because they're using more. In terms of the entry criteria, then I think Alex said earlier, £100,000 is the kind of the minimum threshold. The strategy, the portfolios are designed for at a corporate level, small to mid energy users. So it's where energy is really important to the business. It's a significant cost to the business.
For those that are under that threshold, Inenco does have a sort of an SME division as well. It's not what we talked about today, but there are areas where we can help, the smallest of energy users in that category as well.
Okay. Someone else. We are also tasked with sourcing green energy. What are the best options to address that without incurring a significant price premium?
None. That being truthful, the at a very basic level, the cost of green energy is the REGO. So many people have come across a REGO. If we go back to 2020, then the REGO costs 30 pence. Today, the REGO costs maybe £8. If you think about the cost of energy, we used to, a normal cost of energy was £50, and we're now saying that the Rego at £8 is kind of nearly 20% of the old cost of energy. So that's forcing a lot of people to ask the question whether they can afford to buy green energy this time. I think everybody wants to buy green energy, but ultimately, going back to the CFOs, that they need to make sure that they're managing their costs, and the cost of energy is a very troublesome cost line. We are working with a lot of or some clients in terms of doing something kind of more fancy, where we're seeking to contract them to direct to kind of wind farms on 10, 15-year deals. Does that, but what's that achieving? It's achieving some good sustainability credentials, but it's done at a premium, and a bigger premium over the lifetime of that 10, 15-year contract than the current premium of the Rego for a standalone or a standard green contract. So be very wary of anybody that suggests there's a cheap way to buy green, or green can help you buy cheaply.
Okay. I've heard of people adopting power purchase agreements. What are they and how might they help?
So power purchase agreements are the part of what I've just spoke about. So that's what if I'm a consumer and I want to buy from the wind farm, then I need to get the electricity to me via a supplier. To achieve that, I need to do a deal with the wind farm that says I'd be willing to buy energy for the next 10 years at a price of £100 per megawatt hour, and you will supply it to me via my supplier. It's a very complex piece of work. It's what we're finding is we've taken a few of our clients through the process. We've secured them potential deals for 10 to 15 years. But when that CFO looks at the cost of it, looks at what they're committing to for such a long time, at a time when pricing isn't great in the market, it's I think most people are seeing it as the wrong time to do the right deal. So they want to do it, but the timing's not right. So for a PPA, we'd be happily kind of talk people through them, but we'd be honest and have that conversation up front. It might be a timing thing, and they might want to be buying kind of Regos in the short term, and then maybe 2 to 3 years out, pricing for the PPAs may be better.
Okay. And another one here. Can you purchase the full consumption requirements for the period of 5 years? As we are being advised that some suppliers are only allowing 80% within a 12-month rolling period.
It's a strange one to me because I've not come across that to a large extent. So I think it depends on the. You need to pick the right supplier to start off with. So a supplier that's saying you can only buy 80% is basically saying we want your business, but we don't want to take the risk, and therefore we'll supply you, but you take the risk. And what you don't know now is if you're wanting to buy forward, you're probably wanting to buy forward because you think it's the right time to do it, but you also want the cost certainty. If you can't buy that remaining 20%, then you haven't got your cost certainty. So in our portfolios that we've mainly spoken about today, then you can buy 100% of the energy you need for up to 5 years. So you've got that. You've got the ability to do that, and then on some of the larger flex deals where the consumption is bigger and the certainty of consumption is less, then some suppliers, especially where there's credit risk, will be saying, we can't take all the risk, but we need to share some of the risk. At that point, we're into structuring probably some fairly complicated supply agreements, and we'd be needing to give kind of bespoke advice at that point. But it's not the norm. You can be in that position. If you are in that position, we probably need to work through your kind of organizational specific detail, what supplier and why is that being forced.
Okay. I think that's all we have time for today, unfortunately. But as I said earlier, any questions that were asked that haven't been answered will be handed on to Inenco and answered offline. So with that, it just remains for me to say thank you very much to Alex and to Stuart, and to thank you all very much for joining us today. Thank you.
Thanks, everyone.
Thank you.